Okay, hello everyone. Welcome to this live intraday strategy webinar on SB Trade Desk. We are just getting the release for the U.S. trade balance figures coming out slightly better than expected. Deficit of 41.87 billion. We're looking for a deficit of 42.7. Slight deterioration from the previous print. Nonetheless, not a major market mover though, guys, but hitting the wires at this point. So again, good morning to everyone in the room. Kelly, Kyle, Mark, Permendra, Steven, Besk. Good to see you guys here today. Okay, let's jump right into the charts. So, the dollar seeing some strength, some unforeseen strength here on the back of obviously all the headlines that's going on with what's going on in China, the stalemate in Greece, even the Iran nuclear talks here having an impact on some crude prices as well. We'll go over all those setups. As always, guys, do feel free to throw out any questions, trade setups you guys want to review. We'll go through the setups on the intraday setup first, and then we'll go through your questions. So, before we get started, here's what the intraday chart, or here's what the relative performance rather looks like for the dollar so far. You see the dollar strong against all its major counterparts today. 1.16% decline in the euro. That took us out of the long position that we were in from Sunday at break even for the last quarter of that position. We'll go over that. British pound here with another move to the downside, negative 1.2%. Excuse me. I know that the swing trades are also looking for a position on that as well. So, where does that leave us? Here's a quick look at what the dollar index looks like right now. Okay, so let's start off with the daily. Excuse me. Okay, so you can see that region that we talked about last week. 11,924, 11,935. Region of resistance, we pushed right into it on Friday, gapped above it on Sunday, tried to test it as support, and it held. Here's the rejection, taking us to our next target, which is the 100% extension. Let me bring up the tags on that so you can see a level. And that brings you into 12,008, which is the 100% extension off the low. So two equal legs up. Near-term resistance above this is going to be the upper median line parallel, and that lines up pretty nicely with that 764 at 1237. So momentum is testing a 60 break here today. I'll be watching the close here very, very closely. Remember that we came right into this region here on the start of June trade. 60 held as resistance. We tried to break 60 in April. That failed. So if we do make this break, specifically after a 40 bounce here, we could be seeing some more dollar strength. Again, not the base case scenario, but certainly something to keep an eye on. So again, for those of you trading stateside, I know you can't trade this specific asset here, the Dow Jones FXCM dollar index, but it's a great way to gauge base dollar movements. At its inception, it's equally weighted average with the euro, Aussie, sterling, and yen. So it gives you a nice picture of what's going on in those crosses, and certainly with the relative performance that we looked at earlier, no surprise to see this here rallying pretty hard. So on the 30-minute, and this is what we highlighted yesterday on the intraday radar charts, here's what we were looking at for the dollar index. Okay, so you had that same region that we looked at in the daily chart. There was the probe that we tried to make through yesterday. You can see that even on intraday, momentum held at 40 level with precision. Okay, then you had that trigger break late in the day. This is as the open of Asia that pushed us higher. So the opening range, remember what we talked about if you attended yesterday's. Remember, guys, Monday is the public webinar in Daily FX. We talked about this setup and how we like to use, a lot of times, these gaps. You know, the play is not necessarily to always fill the gap. On a trade like this, what you want to do is you want to use the gap range in and of itself as an opening range strategy. So we gapped higher, we filled the gap. Now the emphasis goes on that gap range. So the high that we made, 11,965, key support we already highlighted. So you're waiting for a break of this range. Here's a topside break above 60. Shifts the focus to the upside. So on a broader case, here's what the dollar index looks like on the 30-minute, okay? Near term, you might find a soft target at 1222. That's an 88.6 retracement, and also that swing high that we made in June. More importantly, 1237, 1242 is going to be those June highs that we made. And like I said, coincide pretty nicely with the upper median line parallel here over the next couple of hours. If this thing collapses back below 70, we make it back below the median line, you'd look for support at the former opening range high. And remember, that's going to be the gap high that we made on Sunday. And that takes you basically right back into 11,969. So that's near-term support. The bullish invalidation level would need to be here. So in order to start shifting the focus back to the downside for the dollar, that's sort of the level that we need to break. But as it stands right now, looking at near-term resistance, like I said, 100% extension off the low for the dollar index here to open up the U.S. trading session. Kyle says the audio is fading in and out. Is anyone else having that problem, guys? Okay, just tweak something here real quick. Okay, see if that helps. So, moving right along. We'll be looking to see if we can hold above that opening range high. Again, it's not necessarily going to be attributed to the event risk that's going on, but we have to take it in stride. And as we continue to push higher here, specifically on the daily chart, we'll look for that June high to sort of cap things off. Again, momentum today, if we close above 60 and we push through 12,000, that would be a big development here in the index. So what does that mean for the dollar crosses? Well, let's go over the radar charts first. Here's the dollar CAD from yesterday, and this is another trade that, in fact, on the dollar strength, was probably the best setup. We talked about yesterday 1.2637. That's going to be the 786 retracement from the decline off the yearly high. As we were talking yesterday in the webinar, he was trying to probe through. We inevitably did close above it, okay, and that keeps the top side bias in play. Momentum finding support at 60 is pretty constructive. Now, though, you're coming into a lot more significant area of resistance, and that's 127.70. Also is defined by that long dated trend line dating back to the highs that we made in 2002. Okay, tagged all three highs that we made in 2002, the slope of that line coming almost perfectly into the high that we made earlier this year, specifically in March. And look where that trend line comes into play, guys, right here. So you have 100% extension off the highs, off the lows rather. You have a multi-year long trendline resistance that's already showed us response this year off that level. And that region comes into focus just here. Above here, you're basically looking for the stretch high, but I'm not interested from a scalp basis, guys, on taking any longs at this point for the dollar CAD. Eileen said, I think you had earlier said the internet connection might be doing it. Yeah, if you're having sound issues with the sound, guys, it might be on your end. GoToWebinar software is actually pretty on point. I'm getting some messages that the sound is not an issue across the board. So keep me updated if you guys still have problems. Raj says, I thought July is the weakest month for the dollar. So traditionally speaking, Raj, yes, seasonality approaches do see the dollar pretty weak. But remember, seasonality is not a causation, right? It's a tendency. So while we are tending to see further weakness in the dollar during this time of year, it's not going to always be a necessity, Raj, right? And again, remember, the markets sort of have a lot on their plate right now. There's a lot that we're looking at. So keep an eye on that, Raj. I wouldn't necessarily stress, those seasonality charts are tendencies, like I said. So again, we don't want to rule out that the dollar is necessarily going to go through the roof here, okay? Yeah, we still haven't cleared last month's high. We're still in that range. But just keep that in mind. It's only the 7th day of the month. So Raj, it's still there. Mike, if it dips back down, does it mean it's a false breakout? Interesting how yen is strong against the dollar. So the yen, my friend, and this is what you'll see people, I'm sure you'll hear this at some point on Bloomberg today or CNBC. Haven flows, Raj, when markets are in turmoil. Obviously, I don't know if you guys have been watching what's been going on in China. The Shanghai index continues to see massive declines. And that coupled with what's going on in Greece, has offered some real market volatility, and these haven flows will tend to favor the dollar, Raj, and will tend to favor the yen. Back in the day when we were in the financial crisis, the Swissy also caught that bit as well. But right now, as it stands, you're seeing a lot of those flows into the yen and into the dollar. Also, keep in mind that the yen, again, you know, traditionally speaking, does tend to react pretty strong to U.S. data, U.S. developments because of its correlation with yields. So we'll go over the dollar yen in a moment, Raj, for sure. That was also highlighted on yesterday's update. But as it stands right now, dollar CAD, like I said, not really looking for long exposure at this point. Here's what dollar CAD looks like on the intraday. So here's the daily. Again, we're looking at that 2770. And the intraday looks like this. Okay, so here was the chart that we noted yesterday. We were actually looking for short triggers. So if you read the note, it said on the lookout for short triggers below this region targeting 126. And the region I was talking about was 126.66. That's actually defined by the April swing high. Let me see where that is. Okay, so it's the April swing high that we made specifically on the 10th, and you had the confluence with the median line off the lows. Okay, so we were looking for short triggers while above this. We didn't get any. The final trigger actually gave out to the upside, and that was confluence to the break above that key region. So again, you could still see a stretch into 2770, 2780, the upper median line parallel, but I'd be looking for resistance at that level. Remember, as long as the intraday oscillator is in overbought condition, you do not want to try to press this to the downside. This condition can remain for a couple of hours. It could remain for a couple of days. It could stay up there for a month. So it's going to be the break back below 70 that gives us any type of near-term conviction to trade the reversal here on dollar CAD. So another one that stays on the radar, not necessarily an active scalp for me, looking to see if we can catch some resistance just a bit higher from where we are here today. As far as CAD data is concerned, you're pretty limited on data until you head into the 9th to get some housing prices, housing starts rather. But really the 10th is going to be the unemployment rate out of Canada. That should be the biggest market mover from the CAD side this week. Obviously non-far, the release of the FOMC minutes tomorrow will actually move the dollar. So also 2 days to keep in mind here for the dollar CAD. All right, and a pair that if the dollar does correct might actually give us some nice short scalps. Again, keep your eye on that resistance here at 2770, 2780. Dollar index also facing resistance at 12,000. So you can envision a scenario where we open up U.S. markets, we press into a new high, and then this thing falls apart. Obviously, if we break and close above 60, above 12,000 here on the index, you'll continue to look higher on the greenback. So another one that's on the radar chart, not quite poised for a position, but we'll be looking to see if that 2780, 2770 level offers some resistance. Finally, before we jump into the actual update on the euro and the yen, here's what crude looks like. And obviously it's making a lot of headlines, guys. You're seeing this all over the board. Everyone's talking about the decline here in crude. I just wanted to point out a major key support that we're now testing, and it's basically the 52 figure. Here's what the crude trade looks like right now. All right. Actually, Raj, I didn't address your question here. If it dips back down, I'll go to that in a moment. But the crude trade. So we held a multi-month range, essentially basically all of May and all of June. We continued to hold that I want to say 58 into like 61 was the key range that we were holding into. On the first day of July, we saw that break below the lower median line parallel. We held right at the median line off the highs. And then again, heading into Thursday, Friday of last week, we pushed right through. That decline, okay, which has been the largest range we've seen in crude for some time at this point, now coming into key support. You're looking at a 1618 extension off of the highs. You're looking at a 50% retracement off of the lows, and the lower median line parallel all coincide right in this region, okay? If we see a continued break below this, it's likely to get pretty messy, even messier than it's been. You're looking for a drop into 49.80. You're looking for a drop into key support at 47 into 47.70. And that was basically the pivot lows that we made here back in March and the start of April trade. Resistance, near-term resistance, 54.21, followed by 55.90, and this is the bearish invalidation level. So as long as we hold below this region, the crude trade is at risk for further declines. I wouldn't be surprised to see a little bit of a rebound here. This is why we highlighted the resistance yesterday at 54 and again 56.90. These are possible entries for the short side. Obviously, a break at the lows, and you're looking for these downside targets here on crude. Okay, again, not necessarily something you want to play as a corollary trade, but looking at the dollar index at resistance, crude at support, might see a little disruption here or a rebound off of those critical levels. So another one on the radar we'll be watching very closely. Again, I know if you're trading stateside, you can't necessarily trade this, but for those of you offshore, keep your eye on that 52 handle. Okay, if that breaks down, sayonara. Okay, we also talked about the fact that the momentum signature yesterday finally cracked and held and closed below not only that 40 level, but now we're probing into the deepest pullback in momentum since the low that we made for the year. And this is something I pointed out in yesterday's piece, but I wanted just to highlight it here again, guys. It's important to note these are very critical points when you're looking at the momentum signature. Why? Not just because it's a low in momentum, but because it's the low in price. If you look, when we started the year, momentum was trading much, much lower, right? But in fact, the low in price was a divergence. So this is actually the low in momentum I'll be paying more attention to, and that's basically where we're trading right now. Okay, continued downside break below this low on a close basis, below 52, and you continue to look on the short side here for crude. Any questions on the crude trade or any other commodities for that matter? I haven't really covered gold here in a couple of days, but that's been a snoozer of a trade. This thing, it's flirting with disaster. It's trying to push below this. We've tried to push below this level a couple of different times. I do want to highlight the weekly charts that we've been following for gold. Really has us coming into a critical area of support. Here's the weekly. Okay, and this is what's published with the weekly, with the quarterly forecast on Daily FX. 1155, 1151, huge confluence region here of support of Fibonacci levels and the lows, both the closed lows and the stretch lows that we made last year, really highlight this key support. So as far as momentum is concerned, you've had a trigger here that's been in place since the year started. That's also being tested. I think you really just don't touch gold here at all. You need to wait to see if this thing breaks below 1137. Again, this thing could see a very quick drop into basically 1100, 1044 would be the next major target, and that's 2010 lows. But this is the major key support region that you want to keep in mind here for crude. So might not be a trade setup per se, but definitely approaching some critical levels here on some of the commodities. Raj says, so are you looking to go long crude? I wouldn't necessarily look to fade it, no. I would be looking to sell a rally, Raj. Or if the break happens, again, you need to wait for some sort of corrective action so you can get back on the short side. Remember, these invalidation levels, guys, are not necessarily triggers for entry on a trade. They're what are going to flip or confirm our bias. So the bias on this one, Raj, broke below the median line and cleared the monthly 2-month range that we held back last week. This was a shift to the short side as far as the bias is concerned, right? Now it's a downtrend at support. So from a scalping standpoint, sure, if you get an opening range break to the top side, you could play a scalp into 54.21. But on a trade like that where you've been coiled up for so long, I'd more favor sticking with the directional trend. So either a rally to 54.21 or 55.90 with a short trigger up there, or if we break, you're not going to get it on the break. You look for a recovery to sell that rally again. Does that make sense, Raj? That's how we work the daily charts. Daily charts are really there to give us guidance on broader directional trades and key levels. The intraday is where we're going to jump in and out of the positions. Raj says yes. All right. GS says a question about FXCM Trading Station Market Scope 2.0. Is there a quick way to copy lines, fibs, etc., drawn on one chart to another chart? No, I don't think there is, GS, to be quite frank with you. You can copy lines by just hovering over it, hit Control on your keyboard, and click and drag. That'll copy it, but that's for the same chart. To copy it to another chart, I don't think I don't think that's able. You can do that. What you can do, GS, is you can create a template. I meant replicate on chart 2. Yeah, you can't replicate it. What you can do is you can create a template. It's not going to copy the analysis. But what it'll do, GS, is it'll copy any indicators that you have on. So if you use RSI, if you use moving averages, if you use any overlay or oscillator indicator, then every time you open a chart, it'll be right on there for you. But as far as the actual analysis, trend lines, fibs, things of this nature, no, you can't duplicate that. He says, got that. Use templates now. Thanks. More than welcome, GS. Okay. And Raj, I wanted to go back and to address your question earlier. Now that we're clear on this crude trade, as far as the dollar index, you're asking if it comes back or dips back below, would you consider it a false break? Not necessarily a false break. I wouldn't necessarily consider this a false break because why? We broke above it, we filled the gap, and broke higher. Remember what we just talked about on the 5-minute chart or on the 30-minute chart for the dollar index, right? It's a pretty clear opening range, and we use the gap range for that. This is a clear validation of a topside break. Okay, so I wouldn't necessarily say it's a false break, but certainly we could run into resistance and come off, right? I don't want to necessarily try to label it a false break unless it recovers within the same day. And typically you invalidate the false break scenario, Raj, when you break above a resistance, come back and check it as support and move off. So resistance, resistance, we closed the week below it, gapped above, checked it as support, then we broke the highs. That's, a clear validation for the near-term trend. So again, testing resistance and looking for a further hold here on the top side for the dollar index. All right, so let's go over the majors now. Raj, we'll take a look at Sterling Key for sure. Remind me in just a few minutes. I do want to take a moment and go over the highlighted charts from yesterday's intraday update. So, first things first, dollar yen. There was actually a pretty decent scalp on this last night for the dollar yen. Here's what we're looking at on the daily chart. So it looks like a little messy here on the dollar yen for the daily, but the key levels continue to hold pretty well. So here's the key. Here's what we looked at yesterday with the dollar index on the daily. Not much has happened since then. We've filled the gap, and we're sort of still holding that gap range. So the same setup applies for what we just talked about with the dollar index, right? Market fills the gap. You use that gap range as the near-term validation for your bias. And right now, dollar yen is still stuck in that range, but we are still favoring the short side. A couple of things. You have a daily momentum resistance trigger that's in play. So we'll be watching that. Key resistance and invalidation for the long side, or excuse me, the short side of the trade, is right around 23.20, 23.30, basically the upper median line parallel. Yesterday was an exact confluence with this parallel off the lows. We'll open up that region a little bit more into 23.40 here. But generally, that's the bearish invalidation level. Okay, you're still looking lower. You need to get through this key support to really open up the next leg down here for the dollar yen. Here's the scale look like as far as the 30-minute. Okay, and there's that same level holding a support. Okay, 123. What is it? 123.30 into 123.38. So we came into this, we rebounded. There was a support trigger here. It was really messy as far as giving you the actual trigger. But on the 5-minute chart, it looked really good. And again, against the high for this session, limits were right down here, and those are out already. So you need to see a break of this range, guys. Some patience is needed. I know from the swing side of things, the swing position's been open for quite some time here in dollar yen. But the buy still holds, okay? And even if you look at the momentum signature coming from way oversold, resistance at 60, couldn't even reach 60, trigger break. Now you're holding 40 as support holds. So it adds conviction to a flat or sideways market in the near term. You want to see this change, okay, this condition of 40-60 change, and you want to see a clearing of the gap range. Long story short, we are looking for short triggers well below the opening range high. Again, bullish or bearish invalidation rather sits tight right around that 123.20 level. You're basically looking at the upper median line parallels off the highs. Mike, where would be a good place to short this? So for our strategy, Raj, it's not necessarily just levels. There needs to be a condition momentum too, right? So I can't necessarily tell you, hey, if it goes to 123, sell. That's not our strategy. We're working intraday, right? So if we get an opening range break today for the U.S. trading session, let's say 8:30, 9:30, we set a range right above this key support. I'm just going to use this as an example, guys. And we sit there, we dribble back and forth up against the support. Then all of a sudden, 10 o'clock, 10:30, you get a downside break, a short against the high for the session might be a good play for a move into 122 in the in the median line off the high. If this thing holds the opening range and you get a topside break moving into the U.S. trade session, along against the lows here would work, but you're only looking to test the upper median line or the upper bounds of the weekly range. So I wouldn't necessarily be interested in the long side as much. Plus, our broader bearish bias is still in play. It hasn't been invalidated, neither on the daily chart or the intraday chart. So if you do get that scenario and we do see a topside break, I'd much rather wait to see if we can find some resistance here, and this would be an ideal short scenario against last week's high. Or, like I said, if you break to the downside, if you miss the initial break, we'll look to sell rallies well below that 123.30 pivot. Does that make sense, Raj? It's really important we kind of get that one aspect down. If you're talking from a swing trader prospect, that's a whole different outlook. But intraday, there needs to be something giving us conviction on that change in directional bias on the near term. Raj says yes. All right. All right. So broadly, still looking for short triggers. Here's what the 5-minute chart looks like on dollar yen, and there was that trigger last night, guys. Okay. So here's an example, Raj, of an intraday position, and how you'd want to play that. So um, we rallied to test basically the initial Asia highs early here in Europe. Here's the European Open in green. We rallied through the Asia highs. Momentum put in divergence. Price action making a higher high. The oscillator making a lower high, followed by a 3-point or 2-point trigger break. So these 9 times out of 10, I will be taking that position. Stop against the high only gave you about 17 pip stop. You're looking for about 22 pips on the targets. You attained well over that. You would have attained two targets on the way down. All right. So I hope that kind of walks you through, how we look to take these positions. Steven says, I took a trigger on a 5-minute in early Tokyo. Would you have taken that early Tokyo? Let me know if this is the one you're looking at, Steven. Is this the trigger you're looking at? Because that absolutely I would have taken. If that's the one you took yesterday, then kudos to you. That's right on. He says, yes, I got the 22 pips. My man. Well done. Yeah, that's a great one too. And again, divergence. Remember, it's not necessary that the oscillator make a lower high. Even equal highs with a high extreme in price action is divergence. So again, divergence, trigger break, stop against the high, looking for 22 pips. Perfect. Well played, Steven. Well played. And again, this is the one that panned out in early European trade. Ross says, I was sleeping at that time. LOL. Yeah. Listen, we can't control when the setups play out. It's just as frustrating for me as well, Raj, especially when all the setups play out in either late Asia or early Europe. I tend to miss those, but um, I hear your frustration, man. You're preaching to the choir. So dollar yen at this point, I don't necessarily want to work with that trigger. It's too steep, too near term. You don't really have a low in place. So even if you take a short from here, and this is one other thing you want to know, not all triggers are going to be operable, guys. So even if there was a trigger here that gave out, wouldn't necessarily be interested in shorting into support. A trigger like that might be something that pans out a little better once you've broken the key level. You're coming back into resistance. You have a clear stop against. And again, at that point, it makes much more sense. But I'm not going to take a short scalp into support, right? We'll want to see this way give out to the downside before we move. Steven says, I had my stops above the New York highs, though. Okay. So it depends on your entry. You're pressing that 22 pip limit as far as your stop. So we want to make sure that we're keeping every trade on a risk to reward ratio that makes sense, Steven. So I love the entry that you had, but here's the one thing I want to note. If you're taking a position based on the opening range strategy, then we need to respect what that strategy entails as a stop. Okay, and the stop needs to be no more than the range of the opening range to begin with. Um, but also as a blanket across this, the board on any trade that you make, you need to have a positive risk reward ratio. So Stephen, it worked out. Well done. Just make sure you're being mindful, because here's what happens in the long run, guys. If you press your stops out and it works a couple times, it's great, right? But in the event that that stop gets hit once, twice, now you're going to start undoing the last two, three scalps that you took. Right? So we want to make sure we're staying objective. And the guys, any strategy, the performance over time is what lets the strategy become a winning or a losing strategy. So the only way that that's going to be constant over time is if we maintain a positive risk to reward ratio at least 1-to-1 on every scalp. So a little note of caution there. Steven says, yeah, I know. I don't mean to harp on you, but certainly it's something you definitely want to keep in mind. All right. Vesk with a comment here saying, well, first of all, seems that you're newer here to the room, Vesk. So welcome aboard. Says, hi, Mike. Great stuff. I'm relatively new here, but I have been going back and watching a lot of the old scalp webinars to try to understand the strategy. My question is this: do you usually wait to be stopped out in your trades, or you do look for an RSI trigger in the opposite direction to take out or to take you out of the trade before the stop is hit? Vesk, that is such a great question, man. Um, and I have to be very careful the way I answer. Listen, over the years, I've been of the mindset that you need to stick to your guns. Um, I can tell you countless times I was sitting on the trade desk in a position that looked like it was going underwater. I'm freaking out. I'm trading the firm's money, or back when we were trading managed futures accounts. It's a lot of stress, right? But a lot of those trades panned out well if you stick to your guns and don't watch the trade too closely. That being said, Vesk, there are scenarios in specific time periods where, yes, a trigger in the opposite direction does take me out of the position. I'll go ahead and jump out before the stop, but it depends on the position. And I hate to give you a wishy-washy answer like that, Vesk, but here's what I want to say. How do I say this in an example that makes sense? It all depends on where the trade is relative to the levels. So, for example, let's say, and I'm just going to completely throw out our analysis here and give you an example, Vesk, so stick with me. Let's say our bias is bullish on dollar yen. And we played the gap to the upside. We got a great entry. Actually, a perfect example. I'm sorry, guys, to jump around, but Vesk, this is a great question. I really want to address it. The perfect example is the euro dollar. Okay, let's go over that from yesterday. And this is an example, Vesk, of which, yeah, I sat in the trade and eventually got stopped out, but not before taking some profit. So here's what I want to say on the dollar yen, or the euro dollar rather. The trade was a perfect play as far as the gap to the downside. The elections or the referendum in Greece obviously created a market shock. I wasn't really surprised with the results as much as you would think. And it doesn't necessarily mean that Greece is leaving the euro right off the bat. There's still negotiations. They're still trying to renegotiate and restructure the debt, right? So long story short, our plan was, even if they do say a no vote, buy the dip. That's exactly what we did. So we got a really great entry on this pullback here. And I'll show you the 5-minute chart. Again, all the exits, guys, have been... Where is it? Sorry. All the exits have been removed, obviously, because it's past 5 o'clock. But last night's break-even exit is still on there. So I showed you this trade yesterday in the webinar. We had taken one initial profit right here, right at the 33 pip ATR that we were looking for. We sat in it again, didn't get out on that last rally into the highs. Remember, we were looking for a rally into 111. Yesterday in the webinar, this thing came right back. We were already taking off a quarter. We took off another half up here. And this is an example where you had multiple trigger breaks to the downside, right? Did that take me out of the long? No, Vesk. Why? Because the entry was so favorable. We were only pips off the low. And if you look at the daily chart, Euro is trading or is coming off of a median line structure or a major key support. So for me, it's worth it to stick into the trade and wait it out. I've already taken 3/4 off. My stop is at break even, Vesk. In that kind of scenario, no, I don't care if I see 10, 15 triggers to the downside, right? We have a great entry. If the market turns, I want to be riding it on the upside. And at the end of the day, I'm risking a quarter of the initial position size at break even. So even if the market goes against me, no harm, no foul. So in a position like this, Vesk, yeah, I'll just hold the position. I'll just wait for it. If it goes against me, it goes against me. We'll have another opportunity. We already took 3/4 of the position off. On a trade like this, I'll hold it. Now, if I was in the original position here, Vesk, I'll give you an example of what I wouldn't do. And we took the scalp to the long side. Great. We took off a quarter of the trade at 33, and all of a sudden, you got a major turn in momentum with a break below oversold conditions, right? Remember, on the rally from the lows, you'll tend to see a spike into 40. As long as that holds and you get more 60 breaks, you keep looking higher. On a trade like that, where we haven't necessarily taken off the position, we're still holding the bulk of the initial position, and we get a compelling trigger to the downside. Let's say we were coming into major resistance or a major key level. At that point, yeah, I might jump out of the trade early and save myself some pain. But typically, I'm in the mindset of stick to your guns. If the trade setup is sound, you have a good risk to reward, let the market play out. So, Vesk, I hope that's not too much of a wishy-washy answer. I hope that kind of gives you a little bit more clarity. There's nothing that's completely static in trading, guys, right? I always like to say every trade needs to be taken on its own merits. But I hope that gives you some clarity. Alan says, one of my absolute rules, born of pain, is not to exit before a stop. Otherwise, what made me place the stop in the first place? Do I follow that rule? Haha, no comment. So, Alan, I hope that I didn't confuse you either. What you're talking about is something a little bit different. I know guys in the room are kind of shifting towards more strategy-based questions. We'll get back into the charts in a moment, but these are some great questions. So, Alan, what you're talking about is moving stops. And that's probably the worst thing you can do in trading, bar none. Bar none. Okay? If a stop is placed there, you've placed it there for a reason, right? None of our stops are based off of a 30 pip ATR or anything like that. That's how much we're willing to lose. But if that stop isn't 33 pips in, I can't take it. If there's not a high or a trendline resistance or a longer term moving average, something needs to be there. So if you're moving your stops, that's the biggest no-no. Stay away from that completely. But getting out of a trade early, if there is a compelling reason to do so, I'm not necessarily against that, but every trade needs to be taken on its own merits. Vesk says, I think it makes sense. Thanks. More than welcome. Vesk, welcome aboard again. And as we go through the setups, man, let me know if there's a question or if there's a scenario that you find yourself where you're in that. We'll be more than happy to take a look at it for you. No problem. Eileen says, where in the euro did you move to stops to break even? After you took the long off twice or after you took it off the first one? So after the first initial position was taken off, the stop was still at the lows for the session. I didn't change it there, Eileen. After we took off the second half, 2/4 were taken off up here. That's when I brought the stop up to below the initial trade. And then as we continue to muddle lower, and once we closed the session, I just brought it right above the break-even entry. And eventually that took out, right? So typically I'll tell you guys, whenever you're taking something off the table, you need to reduce the risk on the trade. So anytime I'm taking something off, I didn't do it on that initial rally because it was just opening up the weekly range. But inevitably, anytime you take something off, you want to make sure that you're reducing the risk on the remainder of the trade. Otherwise, if I take off a quarter here and I get stopped off on 3/4, the broader position is still a loss, right? So we have to always make sure that we're keeping that risk to reward on the scalp in positive territory. All right. So where does the euro go from here, Mike? You told us all about the scalps and where you got in and out, but where do we go from here? So we broke in below the median line off the highs. Again, let me zoom out here and give you the broader setup. Interestingly enough, I might have brought this up last week, but these slopes off the highs are nearly or virtually identical. Okay, so it's something we want to keep in mind as well. Long story short, we broke below the 618 extension. We broke below the median line. You're looking lower below this region near term. Near term support at this point, you're looking for a drop near the 108.80 region, just below the 109 handle as major key support here for the euro. What would I need to get back on the constructive side? Very simple. A break above that same region. All right, so we would need to break right back above this region before you start to look any type of constructive trade back on the euro. I want to take one quick step back. One other thing I want to say to you, Vesk, is well, let me not go there. So I'll stop right there. But this is what we'll be looking for on the euro. Oh, here's what I want to say. On a trade like this, on a trade like this, where here's a slope line, this is a trade where if you're in the position, let's say you're in a scalp, you're looking for 33 pips, you took off 33 pips, you took off another 33 pips on the decline, and now you see some divergence into a trigger break to the upside. I will take off a trade like that. I won't let that stop out if I'm deep in the money. Okay, so if I'm looking for 33 pips and I've already shaved off 66 pips, now all of a sudden we're 70, 80 pips up on the left on the rest of the trade, and then you see a trigger break to the upside in that position, most likely I'll go ahead and jump out. Because we're near term, guys. Remember, if you cut out of a trade, we're near term. It's just as easy for us to get back in, right? So I hope that offers some clarity on that. Broadly speaking, for the euro, you could see a little bit dip of a lower into the 108.80 region. Again, that's a little bit more critical because that's a 618 retracement, longer data retracement off the lows from April. Okay, you saw some nice pivot action here as well, catching the highs, break, catching the lows. That's at 108.80. Again, a break above 109.80s would be needed with a momentum reversal to get us looking back higher on the euro dollar. As I said on Sunday's post, guys, this is open to a lot of event risk. So if you're trading the euro dollar, just stay nimble. Don't necessarily stress what you see in the headlines, but keep your eye on what's going on with regards to the whole Greek saga. Any questions on the euro before we move on? You guys had some great questions here today. So those are the two scalps that we've been involved in the most on dollar yen and euro dollar. We'll continue to eye those as we get to the U.S. session here. Looking for a break in dollar yen below 122.30. Euro dollar looking for some basing. If we rally back into this region, into the opening range, and you see a break or you see a support break, it might be actually a nice short to go for a test of that 108.80 level. But right now, we're flat on the euro dollar. All right, let's move into some of the crosses you guys want to check out. I do see a question here from Bernard. Wants to take a look at the sterling dollar. Here's what British pound looks like on the daily. This was highlighted on the radar charts back on Sunday, and the major key level that we were watching was right here. And in overnight, that thing completely gave out. So you're looking at a basic trendline support off the yearly low. You're looking at 50% retracement from the ascent off of the June low, the June 1st low. And that gave us a nice confluence support here. You saw a quick rebound off it yesterday, but where did we find resistance? At the lower median line parallel, former lower median line parallel. So remember, support becomes resistance, resistance becomes support. Basics. You broke a support, you rebounded off that confluence, you test that former support as resistance. Then if that low breaks, done deal. Done deal. That's what validates the larger break of the formation that we're seeing. So the initial target on such a break was 154.60. We've now run through that. I don't want to get excited about the short side for one technical reason, and I know I've gone over this before here in the webinars, guys, but I do just want to bring this to your attention again. Longer formation median lines off the 2013 highs. We've pivoted off it 6 times. 5, 6, and there's the break. Okay, so that level comes in just lower, right into 154, and if 154 gives out, you're likely to see something like this, something like this, something like this. Notice that every rebound we've seen, I've seen a very strong reaction, right? Very strong reaction. Every breakthrough we've seen, very strong run through, very strong run through, very strong run through. So look for support at 54. If that gives out, keep the shorts in play, looking for 152.70. I know it's a larger trade, but again, the critical nature of that support, if it gives out, wouldn't be too surprised. Larger 50% retracement. I need to stretch that to the new high. We'll come in at 52.46, just below that 100-day moving average. So on a downside break, below 54, below that median line, you look to sell rallies into 152.46, 152.50. All right. What would put us back on the constructive side, or what would be the bearish invalidation level, is this region right here. Same region of support that we highlighted at the beginning of the week. Now resistance. All right. Also look at the momentum signature. Right? We had some strong divergence heading into those highs. Price action making a higher high. The oscillator making a lower high. Right? And then here's the trigger break, and here's the 50 break. So near term, I do think it dips lower. I know that the swing trades are looking for a stop at 54.15. It's going to be tough. 54.05 is where I'm looking at. A little bit different from the swing setup, but that's what I'm looking for as a major hold. And if it does hold, expect to see a rejection like this. Like this, right? Even here on the pullback when we found it as support. It's on a nice rally, another 200 pip, 300 pip rally to the upside off that region. So watch that major key level just above 54. Might be a nice hold if we close above it here today. Does that make sense on the sterling, Bernard? Here's what it looks like on the 30-minute. Oops. Okay. So again, if you take a median line formation near term off the highs, we've been holding this structure for a couple of weeks very nicely. Yesterday, again, we broke back below the median line. The real break was this move sub 155. That's the same exact setup, essentially, as the gap range that we're talking about in some of the other setups that we discussed earlier today. A little bit trickier here in the sterling because we actually did fill the gap and break higher, but momentum quickly failed below above 60, and then you got a nice trigger break to the downside. So it was an operative trade for me to get short here, although this was actually a very compelling risk to reward. But that keeps your focus still looking for a break of the gap range. And that was the break of the gap range low. That confirmed the downside bias. Momentum sub 30 confirms the downside bias. You look for either a 60 break or 30 break here to the upside and a move back above 154.65 near term. Or, like I said, you don't have that longer term trend line here on the intraday chart, obviously, just because of how long it goes back. But we'll highlight that there. That's sort of the amended levels here for the sterling dollar. So to open up the U.S. trade session, look for the opening range. On a short side break, it's tough to really justify any new fresh short exposure from here because you don't really have any session highs or key highs to trade against. So if there's a compelling trigger on a 5-minute chart, guys, your stop really, it can't be much farther than 54.60 on the upside. So keep that in mind. On a reversal break, so if we see an opening range break to the upside, momentum makes it back above 30, price breaks back above 54.60, that might be a nice play back into the median line here. But this is really the region that, like I said, you need to clear to get back on the constructive side of the sterling dollar. Any questions on that? Bernard, does that help? He says, thank you. Let me know if you have any other specific questions there, Bernard, on the pound. And it's interesting that you got that move, guys, because I was just checking the data. Here's the data that we got from the pound, um, earlier in the session today. We got industrial production data, which topped estimates across the board. Manufacturing production really lackluster. Okay, so you saw a May drop into negative contraction territory year over year, looking for 1.8. That grossly missed estimates as well. So mixed data here. Can't necessarily blame it on the data, but in combination with what's been going on in broader markets, not too surprised just to see further strength here in the dollar. So the FTSE is down 0.25, CAC down 0.95, DAX down 0.68. U.S. equity futures also looking pretty flat. 4 handles on the Dow, 1 handle on the S&P, NASDAQ just about flat. So keep your eye on the broader risk trade as well here for broader dollar strength. Remember, the dollar index also, we looked at that earlier in the session, at resistance, right? All right, so let me see some more of your questions here. Mike, can you look at Sterling Key? Looks like it's running out of momentum. Yeah. Here's Sterling Key, Raj. So I was actually checking this out yesterday on the intraday charts. Here's what the intraday chart looked like. Kind of like that 231.85 level. That was a 2618 extension from the decline off the lows. How far back does that go? Okay, goes way back. It's a good thing I didn't try to scroll in the 30-minute. This goes back to the lows that you made on October of last year, and then the lows that you made. I'm sorry, 2013, and then the early low that you made in 2014, which was the actual yearly low. That came in at 231.90 on the intraday chart, 231.85. Regardless, it's also the weekly opening range low now. So here's the weekly open. You came right into that level of support. It was also Friday's low. And then you tried to break through the highs, and that broke. It's starting to look like it could be putting in a topping process, Raj. I agree. Now, let's put a couple of things straight. A short position on this is long Kiwi. Okay, and I'm just going to take a quick look at the Kiwi dollar. I don't necessarily stress these types of correlations, guys, but it's important to keep it in mind. That's my only problem with trying to get any type of fade on Sterling Key. Do you really want to be along the Kiwi dollar? Right? That's my issue. Even from a scalp standpoint, this thing continues to fall apart. And if you look at, for example, Credit Suisse overnight swaps, which is something that we use to gauge what the markets are pricing in, seems like there's a 96% chance for an interest rate cut of 25 basis points at the next rate decision. So markets are just starting to price in a basic inevitability that we're going to see the RBNZ cut rates. If you look at the 12-month expectation, there's still 60 basis points being priced into further cuts from the RBA. Add to that, on this one, Raj, that momentum is in oversold territory, and as long as this position or this condition holds, the market can continue to fall apart. Remember, when you're in oversold or overbought, that's when the market has the most push, not the least. So that's my concern with getting too aggressive on a fade long Kiwi trade, which is essentially what you're doing here. I'll tell you one thing. I would need to get back up below this region. Okay, this median line structure has obviously offered us some great guidance. You can see here we broke above it, support, 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 support before launching through. Also on the broader scale, let me zoom this out for you real quick and show you that pitchfork. This pitchfork formation dates back to the 2011 lows, 2012 high, and 2013 low. Okay, it's been a really good guidance also in price. So for me, I would need to get back below this region to really confirm that we're seeing some sort of shift. I would need daily momentum to get back below the oversold territory. As long as this holds here, Raj, trying to think that it's putting in a top and trying to fade it is a very risky move. Look, once, twice, 3 times, 4 times, something like that might work, but it's going to be sheer luck. And I don't want to trade based on sheer luck, right? So it could be topping, and certainly, like I said, you see a 70 break here in momentum, you see price get back below that region, sure. It might be a nice topping process. But as it stands right now, it's way too early to tell. Way too early to tell. And that's why even on the intraday scalp, you see that momentum, 60 break, 40 hold, 60 break, 40 hold, 60 break, 40 hold. Now you're starting to see 60 give us a little bit more resistance, right? But 40 still in play. So we'll wait for that momentum signature to change as well, and that will give us a little bit more conviction that we're putting in a topping process. For me personally, I'm just not necessarily interested in trying to fade the Kiwi weakness at this juncture. Good question though. It says sounds good. Okay, but can you not take short-term trade a few hundred pips? Again, those few hundred pips would be a lot more attainable, in my personal opinion, Raj, if we have a broader shift in momentum. But right now, I mean, if you were buying the dips, you'd still be making money, even this week. So until that changes, until I see momentum start to shift, price start to shift, even on the intraday chart, even on an intraday trade, um, Raj, I would not try to fade something like this. It's just not my style. I've been stung way too many times doing stuff like that over the years. Um, and like I said, it might work once, twice, great, but it'll be pure luck. So I'll wait for a little bit more of a disciplined approach to try to fade a move like this. I don't even have any topside targets, by the way, guys, beyond this. So we'll need to go back and really assess price action if we continue higher. Raj says, yeah, I was thinking of a 4-hour chart, and a break of the pennant was going to go short. Again, could be a play. I would need to see momentum turn over. Yeah, I see what you're talking about. And not only that, you're getting a couple of indications that might be the play. Momentum divergence, right? Um, but remember, divergence can happen for days, hours, and not even pan out. And a perfect example of that was the dollar CAD. If you look at the dollar CAD, which we talked about in yesterday's piece, and in fact, not only did we talk about this in yesterday's piece, but we even noted, look, there is serious divergence happening here on all the highs that we made since last week. Higher high, momentum make it. This didn't pan out into anything. So a topside break. So again, divergence in of itself, not a trade, right? But good question. Deepesh, hi, can we take a look at sterling yen? Sure can. So if you guys saw MB4X yesterday on the Twitter handle, I tweeted out a picture of sterling yen that was back from the January forecast. So let's take a look at that real quick. Here's sterling yen. Here's the January forecast. I actually saved it. I located it on Daily FX. There's the link, guys, if you want to refer that at any point. But this is the forecast that we wrote back on December 23rd. And we were noting that, 188.27, major key area of resistance that we're heading into. And basically we said, bottom line, looking for a broad pullback in 2015 to offer more favorable long entries. Okay, and that's what we got. To open up 2015, you got a major pullback into a trendline support dating back to 2012. You saw a quick bounce. Even this was a scary break. It was a false break here. Even momentum testing below 50 real quick before the trigger gave out. Okay, to the upside. And we blasted through that major key resistance. We're now testing it as support. And that's the major issue, or the major key that I wanted to highlight yesterday. If we break below down this region, again, 188.26 or so, you look for a pullback into that trendline support. And near term, that would be the bullish invalidation level, specifically as it coincides or highlights really well with that swing high that we made back in February. So this, for me, is going to be a big level here on sterling yen. If we break to the downside, the broader upside trade, in my mind, is still the favorite trade, both from a technical standpoint on a longer term play and from a fundamental standpoint. I mean, you're looking at the BOE, which is probably alongside the Fed as the most prepped central bank to start normalizing rates. And the BOJ, which is still on tap, still going for its 2% inflation target. So this one's going to be something I'll be watching very closely as we come into support here. I'm not trying to do anything on the short side unless this breaks, but this is a weekly chart, so keep that in mind. Also, you have some divergence into the highs from last year, and this thing made a 11-day ripper. It's 10 consecutive days, but that's because, again, the first two candles, count as the first consecutive day. But 11 consecutive weeks, not days, of rallying. Weeks. We've never seen that in the history of dollar yen. Doesn't matter how far back you go. Okay, at least till 1996 or whenever the data that we have ends. So that's something that's pretty big too. On the back of a major 11-week rally, sure, you might see some weakness. You might see some profit taking, especially with the yen strength that we're seeing here as markets go into a little bit more of a risk aversion type of trade. You could get a break of that 88.26, and if you do, look for 84.65 to really offer some support here alongside that median line off the lows. So again, a broader trade, right? Weekly charts. We're not typically looking at weekly charts here. Here's what the intraday looks like and the daily real quick. We are out of time, but here's sterling yen on the daily. All right. So this was the sort of key pivot region that we were looking to stay above. We highlighted this yesterday. The median line off the lows for the year also comes in there. Yesterday we rebounded off of, filled the gap, and after we filled that gap, breaking the lows of the previous day, that confirms near term you want to be looking lower here. So at this point, I'll feel much more comfortable tacking on a retracement of that yearly range. Now that we've had some sort of validation of a near-term top, 70 broke as support, 60 broke as support, 50 broke as support, you better believe near term, that's going to be an important high to work with. And on the back of that, we'll tack on these quick retracements. Okay. Near-term support, the S1. Again, I'm not a big pivot break trader, but certainly when these pivots line up with key levels is very important. Obviously, the S1 lines up perfectly with last month's opening range low. So we'll be watching that S1 monthly pivot. And again, that comes in right around 88.65, I want to say. And then 87.81 is going to be a basic 38.2 and a nice pivot in price here as well. So it's not all done yet. It's not all done and finished yet. Look for momentum support at that 40 level. And if we come into that S1 or if we come into 87.80, we find some basing, find some long triggers on the intraday, that might be a decent play. But near term, below this region, you're at risk for a little bit steeper of a pullback here on sterling yen. And again, an example of where a gap never filled and why it's dangerous just to target the gap fill. Here's what a breakaway gap it's called. That hasn't filled in over a week. So something to keep in mind. Last but not least, here's a 30-minute chart for sterling yen before we wrap things up. Again, let me just zoom this out for you. Okay, and again, there's that median line that looks like we broke, again, not only the median line, but it was a dead-on confluence with the current structure we were working with. Obviously, you don't want to stress these gaps, guys, because price action wasn't necessarily playing through those levels. It's a gap. So still putting emphasis on that. Near term, that's still going to be the level to beat to correct the upside back again on sterling yen. One area of support that you might find right here that wasn't on the daily chart, I just want to highlight, is a 2618 extension near term from the highs. And this is the exact low that you made for that June swing low back on the 10th. So keep that in mind. The actual June low comes in just lower at 188.60. And that's going to be the next near term support target if this breaks. All right. Deepesh says, thanks, man. Hey, anytime. Guys, we are over on time. We're going to go ahead and wrap it up here. I do just want to take a quick gander just for a second on gold. Looks like we're making a tag of that trendline support off of the lows that we made last year in November. And again, keep your eye on that key level, guys. And a 50 break here in momentum. If we close below it, or a 40 break rather, and we push through that region, sayonara. All right, look much, much lower in gold if that scenario pans out. Right now, like I said, still looking for that near-term support to give us some kickback. We'll wrap it up there. Guys, we'll be back on tomorrow, same time, same place, 8:30 Eastern for another intraday strategy webinar. Thanks for everyone attending. Best of luck trading. I'll see you guys tomorrow. Cheers.